Hello, good afternoon. I am Joe Hung. I work with Marin here at the Vancouver office of Casey Research, and I'm glad that you're sticking with me here. It's the last show of the day, and I'm sure you're tired, and you look at analyzing royalty companies, and you feel this is possibly the most boring subject in the entire panel. But the reality is nothing could be further from the truth. Royalty companies provide a very good leverage on upside while providing a very good low-cost downside risk. Let's get started. I know this is a lot of text to go through. I'll just briefly look at, there are 4 different types of royalties. One is right at the top. It's called overriding royalties. Regardless of any sort of deductions, the royalty will be taken. Next is net smelter. Depending on the smelter costs, the royalty will take a percentage of the net smelter return, which is how much they get from the minerals minus how much they get from how much it costs to smelt it. The differences between the first one and the second one are not very big when it comes to precious metal companies, but can be very significant when it comes to copper or other base metal companies. The third one, net profit interest. So it's almost like a tax. So one company can buy 30% of another company's net profit. The last one, and the one that we are very focused on recently, is called the volumetric production payment. This, you might be familiar with companies such as Silver Wheaton, Sandstorm Metals and Energy. These companies all follow this. What they do is they give an upfront payment in exchange for a percentage of all the minerals that's produced, and they pay a fixed price for this product. What are the risks you're looking at? For an overriding royalty or commodity streaming, you have 2 main risks. One is the production level. The more they produce, the more you make. The higher the commodity price, the more you make. As you get to the net smelter royalty, you have a processing cost risk. If it suddenly costs more to transport your ore, then you make less compared to an overriding royalty. A net profit interest, you have many more risks. You have an operational cost risk. If your budget is overrun, then you lose money. The differences between a royalty and a working interest is very, very important and frequently overlooked by a lot of people. In a royalty system, ownership rights are retained, whereas in a working interest, a portion of the ownership right is transferred. This makes a huge difference when it comes to liability, when it comes to court cases. Say you dump a whole bunch of tailings on the soil, and someone sues you for $100 million. If you were the royalty owner, you have nothing to worry about. But if you had a 30% working interest, then you are on hook for $30 million. Aside from the net profit royalty buyer earns cash flow before the profitability of the project. If the project is not profitable, it doesn't matter, royalty owner still gets the money. So let's have a quick comparison. These are the assumptions. You have $3 copper, 60-cent deduction at the smelter, a $1 all-in cost, 80-cent agreed on volumetric price, and a 5% royalty. What you see there on the right is the differences of how much you would receive as a royalty owner. On an overriding royalty, 15 cents, net smelter royalty, 12, net profit royalty, 7 cents, and on a VPP basis, 11 cents. Why invest in royalty companies? Royalty companies are able to buy a whole bunch of different royalties. Whereas one company usually has 2 or 3 projects, a royalty company may own anywhere up to 15 or even 20 royalties, such as the case in Franco-Nevada, Silver Wheaton. So they have a geographical diversification. If Ghana tomorrow decides they want to nationalize all your gold projects, no problem. Silver Wheaton or Franco-Nevada, which owns a little bit there, they lose a couple percent. But if you had a mining project in Gabon, you're pretty much wiped out. Royalty companies have very low overhead costs because all they do is need to administration, and they want to try and acquire more and more royalties. A mining company, on the other hand, has lots of other costs. They have more employees. They have to worry about tailings. They have to worry about reclamation. And believe it or not, royalty companies can provide a higher leverage than the price of a given royalty. What do I mean by that? It means that you actually make more when the price of your underlying commodity moves up. If any of you are familiar with buying options, this is like buying a call option on your commodity instead of buying the commodity. Let's take an example, Sandstorm Metals and Energy. They pay 80 cents per pound of copper when the price of copper is more than $2.75, and 55 cents per pound of copper when the price of copper is $2.75. This was an agreement they recently did with Donner's Metals and their mine in Quebec. As you can see, as the price of copper moves from as it moves from $2 to $4, the change in price of copper is 100%, but the change in revenue for the royalty buyer is 120%. This is very important. So whereas when you move downwards, you have a similar effect. If you are very certain of a bull market in a certain commodity, this may be the right way to play it, instead of buying the underlying commodity or even buying the producer of the commodity. Now, how do we generally analyze royalty companies? Well, royalty companies only have two main real inputs. One is how much they're going to receive and how much the price of the commodity is. As long as we have these two down, we pretty much have nailed it. Of course, this is very difficult, and if I could predict the price of commodity in a year or 2 years, I probably wouldn't tell you how. And we make reasonable estimates on the production of the project. We can do this by looking at feasibility studies, we look at 51-101 reports, and then we kind of guess at the commodity price. So we first look at it at 20% below spot, then we look at it at spot, then we look at 20% above spot. We try to put in different models, and then we figure out, okay, what is the net present value? That means how much are all these cash flows worth today if you could invest this cash flows at 10%. That's the general metric that we use. We also try to find out the internal rate of return, which means how many percent the company is earning, given that because these companies put in a bunch of money at the beginning in order to earn a cash flow, similar to how you may put in a bunch of money to buy a life annuity. Be certain of certain clauses within the agreement. This can be good, sometimes this can be bad. Sandstorm, for example, they build minimum cash flow guarantees into their contracts, which means they have to be paid back in 4 to 5 years. Notice that this does not mean they will earn a positive return, but this means they will get all their money back. This is very, very good. This is a company that we've recommended in the CR. We really like it. It has Nolan Watson, our next 10 as a CEO. They have plenty of cash in the bank. Cash in the bank is so important when you're evaluating a royalty company, because how you're supposed to buy these income streams if you don't have the money in the first place. And from there, we move on to possibly the more important royalty, the ones you pay to governments, and the ones that you pay to also individuals who own the mineral right lands. Government royalties and government take in general is ridiculously high, and much higher than most investors even realize. Does anyone want to take a guess at how much you think the government takes? Anyone? Just yell an answer. For oil and gas. The government, on average, takes roughly 65% of the divisible income. This is higher than most companies' operating costs. This is higher than most companies' administrative costs. Yet, if you go out there and look at oil and gas companies, very few people actually discuss this. In fact, I believe we're one of the first newsletters to even touch on this topic. What is government take? Government take is, I think, one of the most misrepresented statistics and misrepresented numbers I have heard by investor relations people in my life. If I had a nickel for every time that these guys told me what their government take is and it was absolutely wrong, I don't think I need to work here anymore. Government take is not the amount of oil the government takes. It is not the amount of total revenue that the government takes. It is the portion of the divisible income that the government takes, which means after your production cost, after your ongoing capital cost, how much is the government taking? This is very frequently made incorrect by the investor relations people. If the government decides to give you some of the cost oil back, that's not your oil. That oil went to produce the oil in the first place. Government royalties, there are lots of government costs. There are cost of permitting, cost of regulations, you have production sharing contract, government taxes. There's a variety of different ways the government can take money from investors, even before they reach your pocket. Royalties from the government, sometimes they're calculated on total revenue, sometimes they give you a transportation deduction. Very little of that actually matters. The fact of the matter is it pretty much comes right off the top. A 5% royalty is much more significant than a 5% tax. We're going to illustrate this effect later. If you're investing in an oil and gas well in the United States or an oil and gas company in the United States, you need to be aware of what their severance tax is. The severance tax is very similar to a royalty because severance tax is taxed on the overall production minus the royalty. Royalties can be fixed or sliding, and they generally do not change very often except for Alberta, which seems to want to tinker with it every time the price of oil moves. Here we have two comparisons. One is, I have a laser pointer. So here's a 5% royalty and a 15% royalty. In a low margin environment, so say oil price $100, operating cost of $30, the operator gets $52 in the 5% royalty case and $44 in the 15% royalty case. You say, oh, that's not a big difference, that's 20%. That's not a big deal at all. All right, let's move on to the next one. What happens if the price of oil crashes and the price to produce the oil is much higher? Say $80 oil and $60 costs. Now we have a big problem. In the 5% royalty case, the operator gets $12.8. In 15% royalty, $6.4. The difference is double. So ignore these royalty rates at your own peril. The effect of royalties will decrease when the margins increase and when a price increase or a cost decrease or if you increase the production. Why is this important? This means that as a percentage, the government will take less if you're making more money. This means when there's a bull market, the government is taking less. When there's a bear market, when you need the government to come in and protect you, they take more. They will, when you're down on your investment, they will kick you down once again. If an oil sands company were subject to the same royalties in the US Gulf of Mexico, I don't think the oil sands industry would exist in Canada. Just for reference, the royalty in the US Gulf of Mexico is 18.5%, and this has rendered most natural gas companies in Gulf of Mexico completely uneconomic. In order to have an economic project in the Gulf of Mexico at current natural gas, at $3 natural gas, it's at $2.40, you will need to find a deposit of 50 trillion cubic feet. That would be the largest conventional discovery in the United States ever. Now we move on to production sharing contracts because these are kind of like a royalty. First, the costs are taken out. They go back to the contractor in what is called cost oil. The rest of the oil is split between the government and the company. They can be fixed or based on scales and formulas. Be very careful with these formulas. They can be very, very difficult to analyze, even for professionals. And you really have to ask the company, do you know what type of production sharing contract you have? How is the oil split? If a company is not able to answer you, then they probably have no idea how economic their own well is. This has happened frequently. I've once asked a company operating in Kurdistan, do you know what type of fiscal system is in Kurdistan? He says, I don't know, but I'm guessing the royalty is reasonably reasonable. Kurdistan is not a royalty tax system. They are a production sharing contract system. And they take roughly 91% of the divisible income. This is already leaps and bounds better than the rest of Iraq. The Rumaila contract, which was recently signed between BP and the Iraqi government, is magnanimous in granting BP $2 per barrel for all their work. And it goes down as BP makes more money, all the way from $2 per barrel to 60 cents per barrel. The government take is approximately 99.2%, but because how big the Rumaila field is, BP's earning approximately 16% on this project. Moving along, this is the difference between a production sharing contract and a royalty. So usually you have a cost. The cost oil goes back to the company. And as I said before, this doesn't mean the company has earned this money. It just means they've taken this oil and invested it in order to produce this oil in the first place. So you have the profit oil, 50% goes to the government. Government take is about 50%. A 5% royalty, government take is closer to around 26%. Now, PSCs are very frequently used in a lot of jurisdictions. Indonesia, India, Kurdistan. A lot of countries like to use this because it's generally pretty transparent. It's more difficult to, especially for corporate income tax, very easily. There are a lot of loopholes you can get through. Production sharing contracts, very, very difficult. And a production sharing contract which reimburses for all costs without any other features means the operator is pretty much guaranteed to make a profit. Not a good profit, but guaranteed a profit. Con is that profit split is usually much higher than the 50% we just showed. 80% plus is the norm and not unusual at all. And when you combine that with other royalties and taxes, this can be a very, very devastating task for operators. Corporate income taxes, I think we are a lot more familiar. So you have your deductions, you take a revenue, take a deduction, and the government takes a percent, similar to your income tax. And corporate income tax is one of the few things that government take percentage does not change if the volume changes or the price of oil changes. It's constant. Which brings us to one of the companies we really like. I think Marin pointed this out about an hour ago. TAG Oil operates in New Zealand. New Zealand is in a state of they're trying to decrease their income taxes slowly over time. They'll probably decrease to about 48% roughly. And on top of that, they are exploring their unconventional upside. They have other people's money to do this. They have already a conventional production in New Zealand. And the government take is, as I said, roughly around 48.50, which is phenomenal. I think this sounds very high to people until you realize that, Alberta is 65, 66 in some places. Oil sands is much lower, but that's because oil sands requires a lot of capital. In fact, the UK North Sea is now at 62%. So here we have different examples of how government try to structure their taxes. Norway, if you drill a dry well, the government actually gives you 80% of the money back in cash. Very, very attractive. Very low risk. But the problem is that they take 80% of your divisible income to begin with. So it's a bit of a give and take. If you wanted a low-risk project and you're situated in Norway, you're in an excellent, excellent situation. New Zealand, completely neutral. Israel, they have structured it such that if you have a small project at high prices, you earn money. If you have a large project, you earn less money. Angola, you require big, big fields to be economic. Companies there are generally looking for 500 million or even billion barrel deposits. Because anything smaller just means you have put a lot of money for very little oil. Or very little oil in the economic sense. We sometimes focus too much on the overall level of government take. This is important because 70% means a lot more than 40%. But these other factors, such as how much of $1, how much does a company actually save when they save $1? It's called the cost saving index. Very, very important. In the Gulf of Mexico, you save about 60 cents per dollar of cost savings. In Egypt, you save about 10 cents for every dollar you save. which means there's no incentive whatsoever to be cutting costs in Egypt. There are some pretty extreme examples. Alaska, when the price of oil moves from 90 to 105, you're actually losing money. This may be highly counterintuitive. I know it is in my mind when I first looked at it. But the net value of the company at 105 is dramatically lower than 90. This is because they didn't structure their fiscal systems properly. Angola, when you cut costs, you lose money. For every dollar that you cut costs, you're losing 30 cents on your project. You're not making 30 cents, you're losing 30 cents on your project. In Egypt, if you cut costs, all the cost savings go to the government. So there's no incentive there. And before I conclude, there's another very important caveat that within income taxes that very few people have actually discussed, and that is the concept of tax loss carry forward. In Canada and the United States, you carry your tax losses forward indefinitely. Not for capital gains, but for tax losses, which means if you have spent money on a mineral project, you get to deduct this money when you start producing. This is not certainly true of most countries. In Poland, this is 5 years. In Turkey, this is 7. This means if you have very large projects, such as oil sands or shale gas development, you may run into a significant problem. This means all the money that you popped in, it could be $1 billion, $2 billion, you're never going to get that back. This is a huge difference when it comes to shale gas development in the United States versus shale gas development in Poland. Now, unless Poland changes their income tax laws, this will be continuing to be a problem for the Polish government. And I would advise investors to be very careful before they invest in such a company. And that's it. Thank you very much.